So here's your paper. This paper is by a professor named Terrance Odean. He's actually really awesome. He randomly came up to me one time, and I was like in a conference, and you have all the name tags, and I just start talking, and I'm like looking, like squinting. I have terrible vision. I'm like, I know you. I teach your paper, and he thought I was completely insane, but he was really nice about it. So this paper is a very, very good paper in that it gives a very clean explanation of the disposition effect, but also a pretty clean test for the disposition effect in a real sense, in a natural field observation setting. There's no laboratory, no asking of the hypothetical questions, that he was able to actually go in and get actual data of people's behavior in the stock market. So what we see in this paper is that we have individual accounts. We have 10,000 accounts, and we're looking at a time period. Notice this is pretty old. It's January 1987 to December 1993. So if you're going to think about this and you're thinking about these self-serve brokerage accounts, we weren't quite talking E-Trade yet, so it wasn't quite online, but it was some sort of self-service discount brokerage. You can think of whatever the precursor to E-Trade would have been, that we can literally see for each of these accounts on every given day, what do they hold? And obviously, if they hold something today that they didn't hold yesterday, they must have bought it. If they don't hold something today that they did hold yesterday, they must have sold it. So by seeing the daily holdings, we can infer where the buys and sells happened, and we see that very detailed, very granular information for a large population of individuals, which is pretty awesome. So we can think about how would we want to test for the disposition effect. And the whole crux of the disposition effect is that people seem to be categorizing their positions as winning and losing. And to do that, we do have to make an assumption about, well, what is the reference point? And both for computational possibility, because it's something we can see, but also because it seems intuitively reasonable, the paper does make the assumption that the reference point is the point of the price that the individual bought the stock at. And we don't know for sure that that's the case. Maybe if you hold something for 20 years and it started at $6 and now it's at like $400, you may have acclimated to some intermediate price along the way, right? But we're not sure exactly how that happens, and especially since we're just looking at 6 years here, one reasonable guess is that you're sort of anchored to that price that you bought the stock at, so that we can categorize anything that's now at a higher price than what you bought at as a winner for you. And we can categorize anything that is at a lower price than what the individual bought at as a loser for that individual. Notice, of course, that this means that two individuals can hold the same stock. It could be a winner for one of them and a loser for the other, depending on where they bought, right? Because if you have a stock going up and down over time, someone who bought at one of those high periods might see the stock as a loser. Somebody who bought at one of the low periods might see it as a winner. So we're not categorizing these overall. We have to categorize them for each individual.
If you're shorting the stock.
So in this particular data set, I don't think the ability was sophisticated enough for them to be able to do that.
Oh, okay, so just...
Yeah, that, if you're going to think about the ability that you have as an individual, somewhat novice investor, that it's much, much easier just from a logistical perspective to take long positions than to take short positions. So, how would you even take a short, you're going to go buy, borrow a stock from a pension fund or something like that. Like, it's not on an individual basis. There's not a whole lot of that happening.
Yeah, it's more profitable to figure it out.
Well, yeah, and, even a lot of mutual funds, the portfolio managers are limited to only taking long positions, which obviously can be very frustrating because if you expect everything to do poorly, there's nowhere to put your money. But if you could successfully bet, if you could logistically bet on that other side, a lot of these portfolio managers see things that they would want to do that are not within their purview, and then it gets frustrating, because if you have to bet on something going up and you don't think anything's going to go up, that's not a great situation for you, right? But yeah, in this particular context, it's fair to assume that just logistically, these individuals are only able to take long positions so that they are actually hoping for increases rather than decreases. So this assumption that the reference point is the price that somebody bought the stock at technically does not have to be true. And what we're doing, we're going to say, based on this assumption that this is what the individual's reference point is, let's test for the disposition effect. What we're actually doing is some joint test of, is there a disposition effect present, and did we guess properly about the individual's reference point? Because it's entirely possible that we could misspecify the reference point, people would be exhibiting the disposition effect, and we just wouldn't be able to see it. So in order to actually see something in our data, we have to both have the disposition effect happening and be correct in our assumption about a reference point. Which luckily turns out to not be a problem, because it does seem to be the case that these investors are exhibiting the disposition effect. So one thing we could do, and again we said for the purposes of this course that we're going to talk about the results, but we're also going to talk about methodology, especially since you guys seem pretty interested in good experimental design practices, good data analysis practices. And if you're going to be, even if you're looking to be a critical consumer of research rather than a producer of research, it's still helpful to be able to think about asking the right questions so that you can tell when a piece of research is not actually asking the right questions. And so, if we were going to think generally about, we have this data in front of us, we need to do something with the data so that we can answer the question, is the disposition effect present? And we have to make a design choice as to what that would be. That's not the world's easiest question. Like, you read these papers and it seems obvious once you have it spelled out for you, but in the moment it's not actually obvious what you'd want to do. So you could say, well, we could look for each investor. We could just see how many winners they sold, how many losers they sold. Compare that number. If they sold more winners than they sold losers, disposition effect. You're like, that seems pretty straightforward. Why not do that? And, if you think about the research process, maybe that was the initial approach. And what happens is people go and they present their draft papers in seminars, and then people ask questions, people make criticisms, they have discussions, and it's an iterative process. That I envision a scenario, I don't actually know whether this is true, but I envision a scenario where this approach was tried, and someone went, yeah, there's a big problem with just counting the gains sold and the losses sold. We can think about what that problem is. Does anybody have a guess as to why this is problematic? What do you think happened to the stock market over this period? Like the value of the overall stock market? Yeah, especially if we're taking the end of 1987 as our starting point, we're likely starting at a low point. We probably have some sort of increase, right? Yeah. Thinking about that for a second, is it fair to just count winners and losers sold? Right, so put very simply, I think the way that you put that is very helpful, that this approach doesn't account in any way for looking at what you did not sell. It's only looking at that universe of things that you sold and said how many of them are winners and how many of them are losers. Why might that give you an inaccurate picture of the world? Why it might look like you sold more winners than losers, even if you were not actually exhibiting the disposition effect.
It's all kind of messed up.
And that is an interesting consideration, because this paper, and you have to make some choices and just go with them. This paper does categorize winners and losers in an absolute sense. Is the price higher than what you bought it at? And what you're saying is very interesting in that for something to truly be what we consider a winner, we generally wouldn't consider it against a benchmark of 0 versus a benchmark of like the risk-free rate or something like that.
In fact, just a second note, a lot of hedge funds will not charge their service or performance fees to call it if they don't meet a certain benchmark of not 0 usually.
Right, and you have both for the charging of fees and also for the compensation of the managers, you often have a benchmark that is not 0. Oftentimes it's not even the risk-free rate. Oftentimes it's the performance of an index, right? So we start thinking about what actually counts as a winner. And what we choose here to some degree depends on how sophisticated we think these investors are. If these guys aren't very sophisticated, maybe they just are looking in an absolute sense. If they were more sophisticated, maybe they're taking some sort of opportunity cost into account. Let's say this was like Ameritrade or something. I don't know actually what it was. It doesn't say. But got the actual data day by day, seeing what these guys' positions were. There's no interviewing, there's no nothing, which is part of the beauty of it, right?
Yeah.
So I'm going to draw a little picture for you here. Let's think about over time. We have some, overall stock index value, right? So if we were to just say what's the value of the market overall. If we were thinking about the time period in question, and really if we were thinking about most time periods, if we were thinking about a long enough time horizon, we'd see, not perfectly, but, the value of our stock index. It has ups and downs, but it exhibits some general upward trend, right? If we're seeing a general upward trend, what does that imply about just in the universe, the number of winners versus the number of losers? Most likely.
Even without a bias, most trades are going to be winners and not losers.
Yeah, that if we have this upward trend in the market, just in the population of things we could do, because of the way we're defining winners and losers, they're probably going to be more winners than losers. So think about, you could get into a weird situation where, say, 90% of what you could have sold are winners. And you're like, well, I sold 75% winners and 25% losers. You wouldn't really want to count that as the disposition effect. Because you're like, well, wait a minute. Yes, it is true that you sold more winners than losers, but you had way more winners to pick from. So we want to be careful. We're like, wait a minute. Just counting of what we sold, do we have more winners than losers, only makes sense if there are, roughly equal number of winners and losers in the population. Based on what we know of the stock market and its trends over time, we can't guarantee that. And in fact, it's likely that the population itself is going to have more winners than losers. So we've got to adjust for that. And that's exactly what the author does. Says, well, wait a minute. Rather than thinking about just the number of winners sold and the number of losers sold, let's compare and let's make some sort of ratio, thinking about not only the number of winners sold, but the number of winners you could have sold. And thinking not only about the number of losers sold, but the number of losers you could have sold. Now, computationally, this is annoying because think about what you would have to do. Like, think if you're going through in MATLAB or Stata or whatever. If all you're doing is comparing of those things that you've sold, how many were winners and how many were losers, you're like, oh, I can drop a bunch of data. But if you are, in an overall sense, trying to keep track of not only those things that you sold, but then all those things that you could have sold and chose not to, you've got to keep track of a lot more, right? That you now have to keep track of not only the actualized gains and losses, but you also have to keep track of those paper gains and losses. Not impossible, something you have to code, something that has, higher memory requirements, but especially doing this like now, that would not be a problem. But you can see how computationally that would be kind of more annoying. So we can come up with a metric and a statistic to use so that we can actually do this calculation and we can see whether there's a difference. And again, I want to make very, very clear, there are a number of things that this author could have chosen to do. This is what the author chose to do. This is what the author thought was most valid, was, most efficient in terms of high validity, low pain in the neck, whatever. And the reason I point this out is because when I start asking questions about this for a discussion question on exams, a surprising number of people, historically speaking, have decided to come up with their own metrics to say, does this individual exhibit the disposition effect? And then you're doing your own calculation. And I give points for creativity, not literal points on your exam, but like world points. I'm like, all right, that was out of the box thinking. But when I'm asking you to say, based on this analysis, does the person appear to be exhibiting the disposition effect? I'm expecting you to use these metrics and use these summary statistics. And there are a couple things to note. So here, the summary statistics, of course, are what we're calling PGR and PLR. So we have proportions of gains realized and proportion of losses realized. And then, like we said, the proportion of gains realized is just going to be how many winners did you sell divided by how many winners did you have in your portfolio that you could have sold. Which is, of course, another way to put that would be realized gains, which are the ones you actually sold, and then paper gains, everything you could have sold but didn't. Similarly, the proportion of losses realized is going to be how many losers did you actually sell divided by how many losers did you have in your portfolio to sell. And of course, that second calculation would just be how many did you actually sell and then how many could you have sold but didn't. So we have the realized losses plus the paper losses. And two things to note here. One, we are calculating gains and losses as just a very simple comparison to the price that the stock was purchased at, not taking any sort of risk-free rate into account, not doing any of that, just doing a simple subtraction. Second, notice that this analysis, for various reasons that for the most part seem valid, is not taking into account how large the gain is, how large the loss is, that we literally have a binary condition, right? Is this a gain or is this a loss? So this is not directly taking into account how big the gain or loss is. It's also not weighting by, let's say, number of shares, right? So this is actually a lot simpler than it could have been, that we're counting each stock as a unit, regardless of whether the individual is holding 1 share of it or 1,000 shares of it. So it's going one by one in that way. It's not weighting by market cap. It's not weighting by value of portfolio, share of portfolio, anything like that, that it's literally doing what we see here. That we'd say, and if an individual is holding 10 different stocks, each of those stocks counts as a thing. It doesn't matter if there are, 100 shares over here, 5 shares over here, 10,000 shares over here, that's something that's abstracted away from here. Okay. Once we have these summary statistics, we can then ask the question, based on these design choices that we've made, what tests could we perform to see whether the disposition effect exists? And that test is that we have evidence for the disposition effect if the proportion of gains realized is bigger than the proportion of losses realized. To say, now that we've normalized for how many winners you could have sold, and we've normalized for how many losers you could have sold, the disposition effect, or that bias towards selling winners and away from selling losers, shows up if the proportion of winners that you sold is larger than the proportion of the losers in your portfolio that you sold. So, in order to realize a gain, you actually have to sell the stock, right? So, if I bought at 100, I sold at 120, that's a realized gain. If I bought at 100, the stock is now at 120, and I just continue to hold it, that's a paper gain. It's entirely possible, and this is, getting back to what we said earlier, it's entirely possible that either because of, in your example, you're saying the person sells it and buys it back or something like that. That doesn't happen a whole lot. What does happen is someone will purchase more of a stock, which then obviously brings up the question, well, what's their reference point? Was it the original price that you bought that first share of stock or that first batch of stock at? Or is your reference price now the price at which you bought more at? And that's not entirely clear, right? And in the world, we can't be sure for every person what their reference point even is. That if you have someone looking at their stock portfolio every day, I don't recommend that, by the way. That's loss aversion taking over, just waiting to happen. The best thing you can do is just put it to the side. But you could have an extreme case where you have the person looking at their portfolio every single day and then psychologically updating the reference point. And maybe that's happening. The downside is we can't see that happening in the data. And so that's why we said in order to even be able to do this sort of analysis, to be able to even ask the question and answer the question, we have to make some sort of assumption about what the person's reference point is. And so as a design choice, we say, let's just go with the initial buy price and hope that if people are doing things on a one-off basis, that they're not so systematic, they're not so pervasive, that it's making this analysis just give us garbage. Okay. But yeah, psychologically, you're exactly right, that people could be, finagling themselves in various ways that are not consistent with what we see here. But absent something better that we can see, let's just use this and see what happens. That's why we said the test for the disposition effect in this case is technically a joint test of the disposition effect, and have we at least approximately given these people a reasonable reference point. If we're going to say that we see the disposition effect, we're seeing the disposition effect under the assumption that people's reference points were the prices that they bought at. And in order to, so it's basically a joint test, that if we have one and not the other, we would probably just have junk in our data. That in order to see the disposition effect in this data, we have to both have the disposition effect happening and we have to have made a reasonable assumption about people's reference point. So the problem, we said there are a lot of upsides of actual data, that we don't have to bring people into the lab, we don't have to ask them hypothetical questions, that we can see how they're behaving in the wild. The downside of observational data, and we're going to see this in a number of cases, is that because the researcher didn't control the environment, there are going to be things in the data that the researcher would prefer not be there, or things in the subject's environments that the researcher would prefer not be there. And in this case, there's actually a pretty large confounding factor that is going to affect what we see in the data, even if it has nothing to do with the disposition effect whatsoever, and is there just because of particular logistical considerations. In this particular case, that confounding factor is tax-motivated selling. So the way that tax law works in the US is we file returns based on a January through December time period. You know, you have to file by April 15th, whatever. And on those returns, when you have investments, you have capital gains and capital losses, right? And you pay tax on capital gains. And technically speaking, you get a tax deduction on capital losses. However, you only get these things when those gains and losses are realized. So the tax code in and of itself puts an important distinction between paper gains and losses and realized gains and losses. Okay. So, you know, think about a very simple scenario. Say that you wanted to sell a stock. That stock had gone down in value. So it would be a loser to you psychologically. It would also, for tax purposes, be a loser. Because the capital gains and losses are, in fact, calculated vis-a-vis what price you bought this thing at. Would you rather sell that losing stock on December 31st or January 1st?
December 31st?
Yeah. So in that case, you're like, well, if I'm going to get a tax deduction, I'd rather get that tax deduction sooner rather than later, all else being equal. Let me sell this on December 31st, not on January 1st. And so what ends up happening as we go throughout the year, the incentive to sell losers increases and the disincentive to sell winners increases. Just because we're getting to that point where we're thinking about what do we report on our taxes, what is taxable versus tax deductible. And you're like, oh man, I wish I could just like look at this in general and not have to worry about that. But we can't get away from the fact that in a normal, non-contrived observational environment, we have these tax logistics.